Let's talk about something that's been shaking the precious metals world in a way we haven't seen since the 1980s. Silver. The metal that went from roughly $29 an ounce at the start of 2025 to an all-time high of $121.64 in January 2026 is now sitting at around $69.79 as of today, March 29th, 2026. That is a crash of over 42% from its peak. 42%. Gone. In a matter of weeks. So the question that every investor, every trader, and every person who's ever held a silver coin in their hand is asking right now is simple. Is it over? Or is this just the beginning of something much bigger? Stay with me, because we are going to walk through exactly what happened, why it happened, and most importantly, where this metal might be heading next. And we're doing all of this using the freshest data available, not guesswork. Let me take you back to the beginning of this story, because the context matters enormously. Silver started 2025 near $24 an ounce and climbed more than 300% before its peak. JP Morgan. That is not a typo. 300% in roughly 14 months. To put that into perspective, that made 2025 the best year for silver since 1979. The rally was fueled by a perfect cocktail of forces: central bank buying, geopolitical uncertainty in the Middle East, currency debasement fears, a weaker US dollar, and a flood of speculative capital pouring into the metals market all at once. January 2026 opened near $70, and by January 29th, silver had surged to a new all-time nominal high of approximately $121 an ounce. Fortune. That was a 68% gain in a single month. One single month. Veteran traders with 30 years of experience said they had never seen anything like it. And then, almost in slow motion, everything fell apart. On January 31st, 2026, gold dropped over 12%, and silver crashed 31.4% in the largest single-day precious metals decline since 1980. The sell-off extended to mining equities and ETFs. The ProShares Ultra Silver Fund dropped more than 62%. And the iShares Silver Trust ETF lost 31%, both funds' worst days on record. CoinCodex. What triggered all of this? The immediate catalyst was President Trump's nomination of Kevin Warsh, a former Federal Reserve governor widely perceived as more hawkish on inflation and monetary discipline, as the next Fed chair. Prior to that announcement, investors had been pricing in aggressive interest rate cuts throughout 2026, a scenario that historically supports gold and silver prices, as precious metals offer no yield and become relatively more attractive when interest rates decline. CoinCodex. In other words, silver had been riding a wave built on the expectation that money would get cheaper. The moment that expectation cracked, the wave collapsed. And when silver moves, it doesn't walk, it runs. Silver's recent price action has exhibited volatility closer to that of crypto altcoins than precious metals markets, with extreme swings whipsawing traders in both directions. Fortune. The CME Group raised margin requirements on futures contracts, triggering a wave of forced liquidations. The metal bottomed near $74, wiping out billions in paper profits and leaving investors scrambling to make sense of what had just happened. Vietnam. Then came a brief recovery. Silver bounced back above $80 in early February, and then came the second leg down. The Fed held rates at 3.5 to 3.75% and revised its 2026 dot plot down to just one cut, citing persistent inflation from oil prices elevated by the Strait of Hormuz situation. For silver, which had run from $40 to $121 in roughly 14 months almost entirely on dovish Fed expectations and dollar weakness, the signal hit like a sledgehammer. Trading economics. The hawkish hold pushed the dollar index above 99.9 and Treasury yields to 4.2%, both direct headwinds for non-yielding precious metals. Kitco Silver, which pays no interest, earns no dividend, and generates no cash flow, becomes far less attractive when you can park your money in a treasury bond yielding over 4%. That is the brutal math of monetary policy, and silver is paying the price for it right now. Zero Fed rate cuts are now priced for all of 2026. Real treasury yields have jumped to 4.2%, and the dollar is near multi-month highs, all direct headwinds for non-yielding silver. Kitco. Now let's talk about where we stand today, because the technical picture is actually more nuanced than the headlines suggest. According to technical analysis, silver has strong support at $70, defined by late December lows, the February 2nd minimum, and the point where selling pressure halted in early February, and major support at $55, which aligns with the 200-day exponential moving average and October highs. HSBC expects a $58 to $88 trading range for 2026, suggesting current levels may find buyers. The Sunday Guardian. The $70 support has held for the third time since the start of 2026, providing what analysts describe as a potential swing trade bounce. However, the bearish price prediction targets a potential 25% downturn to below $55 per ounce if that level fails. Trading economics. So $70 is the line in the sand. Every time silver has tested it this year, buyers have shown up. The question is whether they show up again and whether they have enough conviction to hold it. Now here is where things get genuinely interesting, because the fundamental picture for silver has not changed at all. In fact, it has arguably gotten stronger. The market is heading for its sixth straight year of a supply deficit, with a projected shortfall of 67 million ounces in 2026. Industrial demand from solar, electric vehicles, and AI data centers now makes up 59% of total silver use, and these buyers are not sensitive to price changes. Kitco. Think about what that means. The people buying silver for solar panels, for electric vehicles, for the semiconductor chips running artificial intelligence data centers, they are not looking at a price chart. They need the metal to build things. When silver falls from $120 to $70, a solar manufacturer does not buy less silver. They buy the same amount, sometimes more, because it is now cheaper for them. That is a demand floor that does not disappear during a speculative correction. Central banks are still accumulating. Governments are still running deficits. Industrial demand for silver is still growing. Geopolitical risks, including the ongoing conflict in the Middle East, show no signs of subsiding. These are the forces that drove silver from $24 to $121. A correction does not erase those forces. It just temporarily overwhelms them with short-term selling pressure. JP Morgan. So what are the major institutions actually saying about where silver goes from here? The range of forecasts is extraordinary and worth walking through honestly. JP Morgan forecasts a 2026 average of $81 per ounce. Bank of America targets $135. Citigroup maintains a bullish second-half target of $110, contingent on the Fed eventually pivoting. Kitco Bank of America's head of metals research. Michael Widmer projects silver could reach between $135 and $309 per ounce based on historical gold-to-silver ratio compression, with the extreme $309 target representing the kind of ratio last seen during the 1980 Hunt Brothers episode. Fortune. On the more cautious end, TD Securities forecasts $65.50. CoinCodex's algorithmic model flags $56.82 as its near-term target, but projects recovery toward $83.92 by year-end. Fortune. So the honest range on Wall Street right now is somewhere between $55 on the downside and well over $100 if the Fed pivots. That is not a tight forecast. That is a sign that nobody truly knows what happens next, and anyone who tells you they do is selling you something. The most credible institutional base case for 2026 puts silver meaningfully above where it spent most of 2023 and 2024, but well below the January 2026 all-time high. These forecasts were built on the assumption that the January spike was partially speculative and that a fundamental reset to the $70 to $85 range reflects real demand without excess leverage. Fortune. But here's the nuance that most people miss. The biggest single-day crashes in silver's history have almost always happened inside bull markets, not at the end of them. Volatility is the price of admission. The investors who get shaken out during the drops are the ones who miss what comes next. Vietnam. In the 1970s bull market, silver fell 45% mid-cycle before eventually climbing to $50. Investors who sold during that correction locked in massive losses and missed the final leg of one of the greatest commodity bull runs in history. If the Fed executes 2 to 3 rate cuts in 2026, the dollar weakens from current levels, Chinese industrial demand holds up, and the COMEX physical stress story does not resolve quietly, then $85 looks like a reasonable entry relative to the $121 all-time high, with a potential second-half target of $100 or more. The supply deficit is not going away. The industrial demand trend remains directionally positive. And gold at over $5,000 per ounce is not cheap for retail investors looking for precious metals exposure. Fortune, on the flip side, if you believe the January spike was primarily speculative, a short squeeze, leveraged retail buying, and Wall Street momentum stacking on top of genuine fundamentals, and that the unwinding of that positioning has further to go, then the bear case to $50 to $60 is worth respecting. The flash crash from $121 to $75 in a single week showed how quickly silver can move when leveraged positions unwind. Fortune. So what is the verdict? Is it over or just getting started? Here is the honest answer. The speculative bubble that took silver to $121 in January 2026 is over. That chapter is closed. But the structural bull market, the one built on supply deficits, green energy demand, central bank buying, and a world that is increasingly looking for alternatives to paper currency, that story is very much still being written. The May Fed meeting is the next major catalyst that could determine which scenario dominates the second quarter. Trading economics. If inflation data softens and the Fed opens the door to cuts even slightly, silver could bounce hard and fast from this $70 support zone. If rates stay higher for longer and the dollar keeps strengthening, that $55 to $60 support test becomes very real. The $70 level is your line. Watch it closely. A sustained break below it with high volume and no recovery would be a serious warning sign. A bounce from it with conviction, especially if accompanied by a weaker dollar or any dovish signal from the Fed, could be the setup for the next big move higher. Silver has always rewarded patience and punished panic. The investors sitting in positions right now are being tested. History says the test is worth passing. But, as always, do your own research, manage your risk, and never put more into any single asset than you can afford to hold through exactly this kind of volatility. If you found this breakdown useful, smash that like button and subscribe, because the silver story is far from over, and we will be tracking every move right here.